Welcome to our ongoing What's Your 2020 Vision webinar series brought to you by Wespath. Today's topic is your Financial Wellbeing 101. I am Cheryl Hatcher, a team member of Wespath's Benefit Plans Department. It is my pleasure to moderate this webinar. Please know that we will be recording the webinar and I will be keeping everyone on mute. As soon as the link to the recording is available, I will be sending it out to you via email. Due to the large amount of information that will be imparted to this large group of people within the next hour, we will answer as many questions as possible that are added to the questions pane at the end of the webinar. Otherwise, the Participant Solutions Center is always available to answer any specific questions relating to your specific situation. Now to get started with the webinar, it is my honor to introduce you to today's distinguished speaker. They are thoughtful and knowledgeable employees of Wespath who take pride in helping United Methodist clergy and laity understand the intricacies of the plans that you have through Wespath. So your incredible team consists of Benefit Educator Frank O'Brien from Long Island, New York, and Benefit Educator Todd Creviston from Montgomery, Illinois. It is now my pleasure to turn the presentation over to Frank O'Brien.
Thank you, Cheryl. Good afternoon from Wespath Benefits and Investments. My name is Frank O'Brien. I am a benefit educator here at Wespath, and as Cheryl said, I live on Long Island, New York. I'd like to welcome you to today's Financial Wellbeing 101 webinar. There'll be a few housekeeping notes to begin with. One is benefit educator Todd Creviston is with me today, and that is just in case we experience any technical difficulties. Todd could pick up if something was to happen to my feed. Please place any questions that you have today in the chat box, and before we conclude the webinar, Cheryl will moderate them and bring them out to us and we can discuss them towards the end of our session today. There will be 4 polling questions. We hope they're interesting, keep you somewhat engaged, that get to where you may be in your thinking around your financial well-being. For the remaining part of this presentation, I will go off camera. This way you can just see the slides and hear my voice and not get distracted by any distractions that I may inadvertently create. So we will get started. This is the latest in this year's What's Your 2020 Vision series, a series intended to support, right off the bat, to support our 5 dimensions of well-being. Wespath looks at well-being in a very holistic way. It isn't just a number like a cholesterol level or outstanding home mortgage. It is how we connect with one another. It's about stress and it's about resiliency, mission and purpose, and ministry. Viewing well-being holistically through these dimensions, physical, emotional, spiritual, social, and financial, brings focus to how we can help people live their best possible lives. And at the individual level, each dimension impacts our personal ability to thrive. Each influences the others, both positively and negatively, which is why we strive to have programs that impact all dimensions. Financial stress can carry over and impact our other dimensions as well, emotional, social, even physical. The focus today will be on the financial dimension. We will review some basics or fundamentals that can aid you through your day-to-day financial lives. Topics that can assist with understanding and managing your available resources, like budgets and cash flow, and begin the process towards financial planning when discussing net worth. As I mentioned, we will have several polling questions throughout today's webinar, keeping it somewhat interactive and I hope interesting. The first polling question asks, how would you rank your overall financial well-being? That is your overall financial health, how you manage your day-to-day finances, how comfortable you are with your financial plans. 1 is being the lowest on the scale and 5 being the highest. So as we launch this and you begin to respond, think about current income needs, debt management, retirement income, those types of things. And Cheryl will launch it and give us some feedback momentarily.
Unfortunately, we seem to be having some technical difficulties, so hopefully everyone is thinking about this question and thinking where you would rank on that list.
Okay, well, we will proceed with the webinar. We are dealing with some of these things in real time as we learn as we go here, so we apologize for that little technical glitch. But we can look at this and we can see we have results between 1 and 2, where individuals may not feel very strong about their financial well-being. Well, our intent today is to help you start to think about how you may be able to get into a better trend. For those in the 3 or 4 area right now, that's good. You've got a solid foundation. Hopefully today's webinar will be able to enhance and build that out further. And for anybody there who did a 5 and hit the highest, that's great news. But again, hopefully some information that we will impart on you today will help you test and validate the plans that you have in place. The topics of cash flow, budgeting, debt management, retirement planning, they form the foundation of the financial planning process and greatly contribute to our overall financial well-being. Regardless of how strong your financial plan seems, the plan is dependent upon a solid foundation. Today's objectives are, or our agenda, we'll look at building and maintaining a budget, notions such as cash flow and net worth, managing debt, saving for retirement. So we'll examine the concepts of cash flow and budgeting, how to measure and utilize our limited financial resources effectively, looking closely at income and expenses. Excessive debt can have a negative impact on our financial dimension. We will examine ways to manage and reduce debt. Retirement awareness and planning is an important component of our financial well-being, and certainly here at Wespath, we do have the retirement vehicles for you to help you along that way. And we will talk a little bit about the United Methodist Personal Investment Plan and saving for retirement. These topics are the most immediate and generally hit closest to home. But with a little bit of time and effort, you can take control of your finances and start building your plans for the future on a solid foundation. And that foundation does begin by looking at our financial goals. What are we saving for? What are our priorities? What are our plans? This requires us to identify and track our sources of income and what our expenses are. Help determine our cash flow. Seeing your household finances somewhat analytically can help you prioritize how you allocate your spending and saving. Anytime during this process, and I will revisit this throughout the webinar, take advantage of EY financial planning services available to you as a participant with Wespath. They truly are a great service for all of us. The first step to take is to outline your financial goals and write them down. To have an idea of where you want to go, it is best to chart a course. If you share your finances with loved ones like your spouse, partner, or children, it's important that all of you establish goals together. As you identify your goals, you can then categorize them in terms of time frame expected to achieve that goal. So we have short-term goals. Those planned within the next 2 years, say buying a car, going on vacation, and looking at debt reduction. We have medium-term plans within 2 to 7 years from now, maybe purchasing a home, getting married, starting and having a family. And then we have long-term, things further out, 7 or more years out, where you may be thinking about purchasing a home in retirement or having a vacation home, having that comfortable retirement, weddings, family graduations, and the like. So we have these 3 categories of timeframes that you can look at in terms of how you structure your budgeting and your saving and your cash flow. So how do we get there? The second polling question would have been or is, have you ever created your own budget? Now, for those of you who have, that is great. Maintain it, and maybe today we can impart on you some new thinking around that. And for those who have not yet created a budget, we encourage you to do so. So what is a budget? It's a blueprint for your spending and saving, a tool to align your finances with your financial goals, a way to keep your spending within your means. This in itself will reduce stress as it relates to your household finances and improve your dimensions of well-being. Remember, the dimensions reviewed do interrelate. Building and managing a budget can be intimidating, and in the beginning can be somewhat frustrating. One of the most important aspects of controlling your budget is to understand, really to see, what your monthly annual income is, where and how that income is being spent, your ability to save for those goals you've identified, and this is important as well. What is your discretionary income to live and enjoy activities today? To help with all of this, we need a tool, a calculator or a spreadsheet that helps you track your income and your outgo. By entering your income and expenditures, you can see how much you have left to save, as well as where and how your money is being spent. So as an action step, build a budget. Notice the attention to detail in a budget. This budget shows both annual amounts and monthly amounts. Place your expenses by categories as well as by type. So for example, utilities with gas and electric. My budget, I have utilities as a topic and gas, electric, water are all separated out. Calculate a monthly and annual average for each category. You can see on this slide it says annual and monthly. Well, mine has January through December, as well as the annual amounts. Remember to account for irregular income and expenses. So for example, I have some subscriptions that are not monthly. They may be every other month or quarterly or annual. And my son still attends college. I don't pay tuition every month, but I know the months I do pay tuition. So this is a way in which you can help you plan for future spending in certain categories that reflects needs, values, and goals. I can see where and when tuition has to be paid going into the future. When crafting your budget, be sure to include a plan to fund an emergency fund that has at least 3 to 6 months of expenses. This will help cushion your budget against unexpected expenses or loss of income without going into debt. This is good financial planning. It provides an opportunity to help you manage costs and expenses and identify an ability to save more as a result, and maybe fulfill that short-term goal of going on vacation and visiting family. And budgets, they can be adjusted on an ongoing basis. So a couple of areas for me, in my life, on the one hand, I obsess about these utility costs. I know in the winter where I'm supposed to be with utilities, in the summer where I'm supposed to be in utilities, and I track that very closely. On the other hand, my wife and I, we enjoy cooking. My wife's a great cook. I really enjoy barbecuing. I barbecue all year long. So we don't bring in a lot of food. We don't do a lot of fast food. So that allows us to have monies being allocated elsewhere as opposed to bringing in meals on a regular basis. As you make adjustments, you will see changes reflected through better spending. For example, you can see some debt reduction. You may see a better credit rating over time, as well as increased savings. So we've outlined and prioritized financial goals. We spoke about the utility of building and managing a budget. We can turn to the next step in seeing how this all ties together. Your income, expenditures, savings. That next step is to determine your cash flow. Cash flow simply is how much of your income is left after subtracting all your expenses, and can be expressed with the following equation. Cash flow equals income minus expenses. This will give you an idea of the amount of money available to achieve the goals you have outlined. This information helps you better manage that budget. The income calculation should be easy to determine. It's what you or you and your spouse make for the most part. The expenses are usually the hardest to accurately identify. But if you outline them as we just reviewed in detail through a budget, it becomes less so. It is important to list all your income sources and include all your expenses. The goal of understanding your cash flow is to know what is coming in and what is going out. It is important for this not to be a negative number. So the cash flow, you add up your monthly take-home pay, whatever you get through income. It can also be investment income that you receive periodically. You estimate your total monthly expenses, remembering to include expenses that don't occur every month. Then you subtract your total monthly expenses from that take-home income, and you get an estimate of your cash flow. This simple example results in positive cash flow, an amount remaining after expenses have been deducted. Negative cash flow is an area you want to avoid, but we all live in that area now and again. So do not get discouraged. We just need to work to get back to the positive column. And here's another area where speaking with someone at EY Financial Planning can provide assistance. As you can see here, we have taken the budget illustration from earlier and layered the cash flow statement on top. The income you receive and your spouse as appropriate is straightforward to capture and note by month and annually. Now, you can use the gross amount in itemized taxes, healthcare premiums, retirement savings, and such for your own tracking purposes, or just the net amount received and deposited. You have your total expenses from your budget. Income minus expenses provides your cash flow monthly and annually. The proposition that better managing expenses can result in a positive impact on cash flow can be proved out one way or the other by tracking your cash flow. And where positive cash flow is realized, you have the opportunity to better manage debt, save for your goals, and now and again go to your favorite restaurant for a relaxing night out. So for those of you with a budget, please stay with it. For those of you not using a strict approach to tracking income and expenses, we encourage you to start developing a budget. But start off slow. Give yourself time to record your activity over several months. As you do your banking, record what you're writing and what your bills are. Let it take 4 to 6 months and build it out. Note regular and recurring expenses as we've reviewed. There is no right way or one way to track your expenses. Some options include the old-fashioned notebook method, just writing down your income and your expenses in a notebook and tracking them accordingly. As myself using a Microsoft Excel, use a spreadsheet program. You have Microsoft, Google Sheets, Apple Numbers. There's many personal software and mobile apps that you can use, mint.com, Quicken, etc. Probably go on Google and see a whole slew of them and find one that you like. The important point is that you find a method that is comfortable for you. Once you have recorded all of your income and expenses, you can create a monthly cash flow statement and see if your cash flow is positive, there's money left over, or negative, that you may be tapping into some savings or inadvertently adding more debt. And with that, we'll spend some time talking about debt. So our next section, we'll look at debt management and debt reduction. Debt has been identified as a significant cause of stress among our clergy and lay participants. Proper debt management can help increase our financial well-being. So this
polling question is here.
Yes, we can do this?
We can.
Okay, so the next polling question is, have you ever worried over your debt, how debt has impacted your financial well-being? If you would please answer yes or no, and then give Cheryl a few moments, and then we will get the results.
With 94% of people who voted,
Yes.
87% did say yes, that this is an impact that they have worried about.
Okay, well, our hope and intent is that today's webinar and other resources that we'll touch on will help people start to move off that worry as they better understand how to track and manage their debt. So thank you for that, Cheryl. As you can see here, looking at the top and bottom rows of this table, statistics relating to debt management, generally we see that a significant percentage of clergy can use help with their personal finances, and debt is a consistent source of anxiety. As I just said, we hope that today's webinar will help to fill some of these gaps. As we proceed speaking about debt management, it should be mentioned that there is good debt. For example, having a mortgage on your home is good debt. So not all debt is bad debt. Managing debt is what's crucial. It is not having debt that is problematic, but the type of debt and the expense of certain debt that can be wearing on us. After you have established your budget and determined your cash flow, you should be able to determine if there are any resources remaining to focus on other priorities. First, it is important to establish an emergency fund, an amount set aside to cover unexpected events such as job loss, medical or dental emergency, unexpected repairs to homes and cars. As a rule of thumb, you should have 3 to 6 months worth of your expenses saved in this emergency fund. Then move on to considering consolidating your debt. This can include certain items like student loans or personal loans and maybe some other credit card debt. Debt consolidation is a form of debt refinancing that entails taking out one loan to pay off many others. So spend some time understanding what type of loan you're receiving to do this debt consolidation. Prioritize your debt payments. Review your account statements to know what are the outstanding amounts, as well as what are the rates of interest you are paying on that debt. Rates of interest on credit cards are still very high. Then you can focus on paying off the debt. There are differing strategies to do so. For example, the debt with the highest amount of interest, pay that one off, or the debt with the lowest balances, something called the snowball effect. Current debt reduction strategies, as well as thinking through future borrowing needs, is another area where EY financial planning can be of assistance to you. As we move along this discussion, you're heading toward a financial planning process. I will conclude shortly with a review to determine your net worth, another piece of the financial planning puzzle. As we have discussed, managing a budget and understanding your cash flow may result in some trade-offs to maintain financial fitness. It can be about making choices. As a choice, debt management and reduction should remain a priority to achieve or improve your overall financial well-being. Some of these choices can be difficult, requiring some sacrifice. However, some of these choices can be opportunities to fund future goals, for example, retirement. Before moving on to the topic covering calculating your net worth and concluding today's webinar, I will spend a few moments on certain questions that can help you frame an evaluation of your current circumstances and opportunities available to you at Wespath to fund your retirement goals. As we think through some basics of financial well-being, budgets, cash flow, debt, here are several questions that can help you take a fresh look at your spending. What spending is fixed? What spending is variable? That which is necessary, that which is discretionary, and how does the variable and discretionary spending interact with one another? Am I managing debt, or am I just chasing it? Paying off one thing, but really taking on debt somewhere else. And to what extent does my spending support my financial goals? Our next section will look at saving for retirement, one of those financial goals we all share. Uncertainty about retirement planning and retirement income can be a cause of stress and impact our financial well-being. Having a holistic household understanding of your finances can reduce that uncertainty and help you see your way toward a comfortable retirement. The opportunities for saving for retirement can be realized through good financial management. But this does lead to the question, in retirement, where will my retirement income come from? Some, but not necessarily all, of the sources of monthly retirement income will be what Social Security income you derive, any personal savings investments that you have, and taking advantage of the retirement savings plans that we have available for you at Wespath. With our clergy persons, we have the Clergy Retirement Security Program. For those clergy longer tenured, there is the Ministerial Pension Plan. And for clergy and lay, we have the United Methodist Personal Investment Plan, or UMPIP, or UMPIP. Many of these sources of income can come from your spouse as well, whatever they may have in retirement or personal savings and their Social Security income. One thing to note is that this monthly income, or quote-unquote paycheck, may not by itself replace your entire pre-retirement paycheck. But that said, however, most financial advisors will say you need about 70 to 80% of your pre-retirement income to live comfortably in retirement. And this is referred to as replacement ratio. Our next and last polling question will ask your participation in the United Methodist Personal Investment Plan. Please indicate when was the last time you updated your UMPIP contribution percentage. Within the last 6 months, 7 to 12 months, more than 12 months ago, or never, you have not yet had the opportunity to enroll in UMPIP. I see Cheryl has opened the poll. And it must be said here that we'd recognize that anybody who has done within the last 0 to 6 months may have gone to reduce it because of the coronavirus situation we live in. But you'll hear us at Wespath often encourage people to not only enroll, but to increase over time. So hopefully anybody who's had to live that will be able to get back to normalization fairly quickly. Are we still collecting, Cheryl?
We are, but with 81% of the people who have voted, we have 69% has said more than 6 months ago was the last time they actually put or changed their percentage in the UMPIP.
More than 6 months ago.
More than 6 months.
Okay. Well, that actually is a telling statistic, and that, and what I just said about the coronavirus may not actually be the case, and people are still able to hold steady. Did we have anybody come through with a never and not enrolled in UMPIP?
We did not.
Okay, that is great news to hear. Glad to see people taking advantage of the benefits available to them. So take a few moments on the UMPIP, United Methodist Personal Investment Plan. UMPIP is a defined contribution plan. The government defines how much you can contribute annually. You decide how much you want to contribute and to what type of account. You decide where and how to invest within the Wespath investment fund family. And in certain instances, the employer can also be contributing to an account for your retirement in UMPIP. As noted above for clergy persons in the Clergy Retirement Security Program, if you are contributing at least 1% to UMPIP, you will receive your full CRSP benefit. Although we encourage participants to contribute more than 1%, at a minimum, clergy persons should be contributing the 1% to UMPIP to realize that benefit. As just mentioned, the participant decides into which account to contribute, and there are several. There is before tax contribution of account, where you avoid taxes now and defer taxes until you receive distributions in retirement. These contributions are not subject to clergy Social Security taxes, or SECA. With Roth, you pay taxes now and avoid paying taxes later. This account needs to be structured correctly, which generally means you must be age 59 and a half or older, and the first contribution must be in the account for at least 5 years to receive tax-free distributions. There are some situations where after-tax contributions might make sense for a participant, those who actually are bumping up against annual limits each year. UMPIP accepts direct and indirect rollovers from other IRS qualified retirement accounts, 401ks, 403bs, 457 government plans, traditional IRAs. Another shout out for EY Financial Planning, as they can help you think through whether it makes sense for you to consolidate your prior retirement accounts within Wespath. So now coming back around, our last Financial Wellbeing 101 topic to touch on covers the net worth calculation. Earlier we talked about cash flow, but net worth and cash flow are important tools. Both net worth and cash flow are important tools. Reviewing your net worth should be done annually. Oftentimes this is done in January as people lay out their New Year's budgets. Others, however, have a regular time of year where they meet with their EY representative or other financial advisor to review their financial plan. And this one looks a lot like cash flow. The calculation itself is straightforward. Your net worth equals assets minus your debts. What you own minus what you owe. Here's a simple example of a net worth calculation. You will need to understand what you own and what you owe. Assets, home value, retirement accounts, investments and savings, maybe your automobile. And you have your debts, the mortgage on that home, any student loans, credit cards. Do you have any loans out on that automobile? The net worth will be the difference between your assets and your debts. So here, $425,000 in assets, $125,000 in debt, a net worth of $300,000. To take it a step further, documenting and recording what you have and what you owe, another spreadsheet or something similar, can assist you in seeing the numbers as they present themselves. As stated earlier, the important point is that you find a method that is comfortable for you. You list out your assets, you list out your debts, and then you can see the difference in your net worth. We've used the same numbers, 425, 125 in debts. You have the $300,000. Here, net worth can be either a positive or a negative number. But whereas a negative cash flow number brings with it a sense of urgency, a negative net worth number does not necessarily have the same urgency depending upon where you are on your time horizon, your home ownership situation, current and future child educational expenses, etc. Important thing is to continue to track and maintain your net worth statements, your cash flow, your budgets, and how they all tie together. So with all of this, do we have resources available to you at Wespath? And we have a plethora of resources available to you at Wespath. We pride ourselves on doing these types of webinars and seminars when we can get back out on the road. We believe in the education of our participants and the benefits that are afforded to them. These webinars, the What's Your 2020 Vision series videos, all will go up on wespath.org. There's other materials on there. You can get a lot of information on our investment funds on that website. We encourage you to do so. And then, as I've mentioned several times, EY Financial Planning. Think of EY as your strategic financial partner. They provide confidential, professional financial counseling at no additional cost to you. The cost is covered by the operational expenses of the Wespath investment funds. There's no out-of-pocket expenses to you. It's unlimited in terms of the days and hours of time that you spend with the financial planning counselors via telephone. They will provide you objective advice. They will not position anything for you, and there'll be no sales pitch attached to anything. They are a resource that can help you think through your household finances, especially during these uncertain times. So we encourage you to go on to wespath.eynavigate.com or call the 800 number 360-2539 and reach out to them. With their articles and tools and resources, you'll be able to get your accounts all put together, aggregate those accounts as it states there, and see everything completely and holistically. They can provide a financial wellness assessment for you. They can also do a risk tolerance assessment for you in terms of how comfortable you are investing. Are you conservative, moderate, aggressive? They'll be able to capture all of that information and help you think through your current, midterm, and long-term financial plans. So hopefully the objectives I reviewed about a half hour ago are starting to turn into some actions. So as a follow-up to this webinar, track your expenses for 3 to 6 months and build or test by maintaining the budget you may already have. If you don't have a budget, build that budget. Create a cash flow statement, your income minus your expenses. Determine and prioritize your financial goals. Start or continue to plan and save for your retirement. Review the retirement plans we have available for you. Make that phone call to EY Financial Planning. We do think they provide a great benefit to us as participants. We hope you've enjoyed today's webinar. Our hope here is this will provide one means to help you navigate the 5 dimensions of well-being. Now I'll provide the microphone back to Cheryl. Todd and I will come back on camera, and if there's any questions that have come through, we would be more than happy to field those questions.
All right, thanks guys. So we did have a question come in, and it's dealing with one of our clergy spouse. So they happen to have an irregular income, and they're wondering how can they even try to come up with a financial budget when the income for that one spouse is not regular. Do you have any tips or guidance for that?
Well, is it irregular in terms that it's truly unknown, 3 months out, 6 months out, or a year out? Or is it irregular in that there's times of the year where the income is there, and then there's times of the year where that income is not there? I think in either one of those scenarios, or a scenario similar to that, being able to estimate on a time frame basis, looking at that budget and having all of those months laid out in that budget and plotting in numbers, you'd be able to estimate and then track what that income may be. If it's unknown what the income is going to be next quarter, next year, that certainly is harder to track, and you may want to reposition where that money would go and see if there's opportunity there, cover everything with the income that you know is coming in, and then maybe some of this irregular income, if available, can start to head into some savings or debt reduction.
Right, yeah, that's some great advice there. Another question we've received is any guidelines or directions to help with the credit score when paying off debt?
Credit score is a very esoteric type of thing, and that's certainly a topic that you can go deep with EY. It's a catch-22 with your credit rating. You get credit cards, you're supposed to use them. If you don't use them, you don't get a credit rating. So you have to use some of your credit cards and then pay them off right away to get the stronger credit rating. So how you're actually managing the debt repayments as well as utilizing those debt instruments is something I would really defer over to EY Financial Planning and let them kind of rationalize that with you. I think that would be better.
Okay, makes sense. Another question we received is, any advice for paying quarterly tax payments?
That would have, I hate to defer another question to somebody else, but anything like that when it comes to taxes and tax payments, we have to point you back to your accountant and sit down with your accountant or your tax preparer and understand what's the best opportunity for you in terms of quarterly payment or annual payment. And I know there's some tricks to that you want to be mindful of so you don't get any penalties at the end of the day.
So those are all the questions that we received.
Okay, so my last thought on that then would be definitely reach out to the EY Financial Planning folks and anybody else, financial counselors, state attorneys, accountants, as part of the team that can help you really understand your household finances.
Sorry, we have one more question that just came in.
Okay.
We have federal student loans with high interest rates. Which is better to choose, private loans with interest rates or federal loans with high rates? So the question again, which is better to choose, private loans with low interest or federal loans with high interest when you're dealing with federal student loans with high interest rates?
Yeah, again, another question that EY Financial Planning would have the better way of answering that question with more technical detail, more understanding of how those regulations and those interest rates all tie together. And another thing to think about right now is, as I know with all of this CARES Act and coronavirus environment that we're living in right now, that there's going to be some way, I think, of some breaks that's going to be attached to some of these student loans. So whether that hits the private marketplace, I don't know, but I think there's some provisions in the CARES Act for federal student loans.
Okay, that's all the questions we've received.
Okay, Cheryl. You want to bring us home?
All right, so thanks again, everyone, for attending. Todd and Frank, thank you very much for all the information. And this information will be sent out to you via email if you'd like to listen to it again. And we thank you again. Take care. Have a great rest of your day.
Be well and be safe.
Thank you.